recipes for technical trading success in Cook's Kitchen.
Time for an autopsy on this correction. We're going to look at some key indicators I like to tell me when a bottom is close at hand, and we're going to use a special tool that institutional investors use called equity risk premium to help them decide if they're plowing money into stocks or taking money out. First, let's go to some charts. I showed my Taser members last night. That would be Wednesday, October 24th. Looking at my screen here, this is something I like to look at. How many stocks in the S&P 500 are trading above their 200-day moving average? And on stock charts, it's just this is the symbol you put in, SPXA 200R. And so I'm looking at the percentage of S&P stocks above their 200-day moving average. I was looking for this to dip below 50. We definitely did. As of yesterday, we got down to only 34%. And I'm comparing this. I'm showing a 5-year chart so you can see what happened during the corrections of 2015 and 2016 when we had a big earnings recession. And the difference now is that 2018 has been tremendous earnings, but the stock market had barely corrected. So many stocks were above their 200-day moving average. We started to see breadth weaken, and so that's why this number can go so low, down to 34%. All right, next chart I'm going to show you is looking at the S&P 1500. We want to look at new highs versus new lows. So on stockcharts.com, the symbol is SUP, HLP. S&P 1500, as you know, it's the big caps plus the S&P 600 small caps plus the mid cap 400. You get 1500 stocks. Okay, again, 5-year chart. What kind of washout levels are we looking for here? I like this, down to almost 20%. And this data was as of October 23rd, but I just checked the refresh for last night's data, October 24th. This actually ticked up a bit. So 16.8 negative is the reading there on the new highs minus new lows created as a percentage. We don't need to see it get down. We don't need to see anything get down to these 2015, 2016 levels. We just want to get as close as we've been. All right. One more, we're going to talk about the put-call indicator. Now, everybody likes to watch the VIX, talk about the VIX, but the VIX isn't going to give you clean levels that you know when a market bottom has occurred, because every oscillation in the market and every correction is a little bit different. So a VIX above 20 right now doesn't mean as much. In fact, the VIX could stay elevated. We could have an elevated VIX into November. So what I like to use is the put-call indicator looking for extreme readings. So in the version I'm looking at is the total put-call ratio, which includes indexes and equity options. It's CPC on stockcharts.com. Again, 5-year chart. Where are we? Well, as of last night at 1.3, basically, meaning 1.3 puts to calls in indexes and equities, we're not that extreme. Certainly not as extreme as the February through May corrections, or through April, I should say, when that thing got above 1.5. And you look back, even in 2017, we had higher peaks. So this told me we haven't seen ravenous put buying that would indicate massive fear and a bottom. So again, the VIX could go to 30. Hey, let's check in with the VIX while we're here. So I'm over on stock charts. The market is bouncing nicely. I wanted to see the NASDAQ 100 go test 6,900. It did yesterday when it collapsed. VIX is coming back into 22 here. Okay. So let me show you the chart I showed my folks last week here. I'm going to show you what I did is anytime we head into a correction, I want to say, okay, where could this go? What's the worst case scenario? And then decide, here's where we're probably going to be buyers. And hopefully we're short some on the way down. So this I would have to go to I think I got the chart here. I reproduced it anyway. No, I don't have my chart. Here we go. Oh, we did it. We shorted the NASDAQ 100. It should be in here. On Monday, we shorted it using the SQQ. Okay, so here were my targets. I said we've got to go test this 6,900 and the NASDAQ 100. We definitely did, and the thing collapsed 2% in the last hour, and we actually went below 68. So these were the targets I gave people over the. I made this chart on Friday, October 19th. Was showing it all weekend. In worst case scenario, I said this could go to 6,500. Now we've got Amazon earnings tonight, which I think we're getting this bounce in the NASDAQ on deeply oversold conditions, as I just showed you with all those indicators, and hopes that Amazon pulls through. You got Apple and Microsoft stocks holding up well, but Amazon's got to kill it here, and the market's got to love it for Amazon to get above 1850 and get out of its downtrend. I don't know if that's going to happen. Okay, let's go to equity risk premium. This is a tool institutional investors have to look at the market. It's a way they value the earnings versus the bond. Okay, so first let me show you, I posted this on Twitter a couple weeks ago. This is from Morgan Stanley. If you zoom in on this, this is valuation in the context of rates. So, and they're talking about equity risk premium versus the 10-year bond, the 10-year note. On this side is, you got a bunch of PEs, forward PEs, but we're going to concentrate on how they flip that into index levels. Okay, so let me explain something real quick. You know what PE is, price over earnings. So, and this data from Morgan Stanley, this table uses an assumption that the S&P is going to earn $174 in 2019. Okay, that's high, and growth expectations are coming down, and that one may come down. But we're just going to use 174 because that's how this data is calculated. Now, the PE at S&P 2700 is pretty decent. It's under 17 times. So it's attractive. But what we're going to do is we're going to flip the PE and talk about and get the earnings yield. So it's E over P. So we're going to put 174 over an index number, and then you get an earnings yield, and you get something like 6.2%. That's what you're getting. That's what you're earning in the S&P 500 when you flip the PE into its earnings yield. Okay, 6.2% sounds great, but institutional investors want to back out the 10-year rate. So let's say the 10-year is at 3%. So then you're talking about 320 basis points of yield being in equities. And we can convert that into a price. So if you look at this table again from Morgan Stanley, just line up rows and columns here. Let's say we're talking about institutional investors want just 300 basis points of risk premium over the 10-year bond. So 300 over a 3% rate means values the S&P fair value at 2906. So if you can line that up, I should have found a chart where I didn't have to look over the top of this Twitter nonsense here. But okay, that's a better look at it. So this 2906, again, it comes from if equity investors only want 300 basis points of risk premium from their equities on top of a 10-year bond trading at 3%, that's 600 basis points, it prices the S&P fair value at 2,900. But what if they want 350 basis points of risk premium, meaning they're pushing the price down because they want a better edge. They want equities to pay them more, a higher earnings yield essentially. And let's say that's on top of the 10-year at 3.25%. So 350 basis points of risk premium on top of a 3.25% 10-year yield. That's 675 basis points. And so line up those columns and rows. We'll take 350 basis points of equity risk premium here where I'm circling versus the 10-year yield at 3.25. That says fair value on the S&P is under 2,600. So this is how equity risk premium works. And it's not an exact science, but it's large investors have big portfolios, and they have to plug stuff into their models that that gives them different views of what risk they're willing to take, what risk exposure they have now, where they would be net buyers of the index to try and outperform it, and where they would be maybe net sellers. And so Morgan Stanley, that team, Mike Wilson, his strategy team, they've been bearish for basically all year since the February correction, on a peak in earnings, a peak in growth, possible impacts of trade battles. And so their ideal trading range is, hey, we want to buy under S&P 2600, and we don't know if you pay that much more than 2900, meaning they're not really looking for new highs. So that to me, that's code for the market continues to grind lower here into November. But we've had a quick, fast washout, and so we're getting this oversold bounce. I hope it all doesn't depend on Amazon tonight. Let me see if I had one more chart I wanted to show you here. Nope, that was it. So, in conclusion, equity risk premium. Shoot me an email if you need a link to understand it better, or just go to my Twitter page at Kevin B. Cook, and you can find that graph, and then just play with it. Remember, the only thing you're not told in that table is the assumption of $174 EPS. So that's the only unknown there. Plug that in, and you can flip those numbers around, and you can see sort of the risk ranges that institutional investors will use in this new era. What's the new era? It's rising rates. Okay, we haven't really experienced this impact on tremendous earnings and growth and value in equities. We've never had to say, well, what about rising rates? And now investors can start to say that, especially if growth is peaked and expectations start to come down, especially if that 174 comes down. All right, that's my equity risk premium spiel. Find me on Twitter.